Euro this morning. The DXY dollar index is actually sitting at one-year lows today. And joining us now is a money manager who says that this may just be the beginning of a further decline in dollar-denominated assets. He's Peter Schiff. He's the CEO of the broker-dealer Euro Pacific Capital out of Stamford, Connecticut, coming to us this morning. David Malpass, the chief economist at Bear Stearns, is also still with us here on set. So let's start off, Peter, with this idea that you think that these declines are going to continue. Why is that?
Well, first of all, it's not necessarily the dollar just falling against the yen and the euro. The dollar is pretty much falling against every currency on the planet right now. We're at a 28-year low against the Canadian dollar. And the reason that the dollar has been falling for the past several years, actually it's been falling since 1972, but we have had periodic bear market rallies. But the main reason is because the United States economy, is just not saving enough and manufacturing enough. And we are running enormous current account and trade deficits, and the world is getting tired of financing them. And as we continue to export, trillions of dollars into the world economy, and the world has nothing to do with those dollars except sell them, there's going to be tremendous pressure.
But Peter, that was all true last year, and we certainly did not see dollar weakness last year.
Well, we saw a bounce, and we had fallen for a few years, and then we had the Fed raising interest rates, and nothing goes down for a straight line.
Well, okay, Peter, the dollar was very strong in the late 90s, from 96 all the way through 2000. What do you make of that?
Well, we've had bear market rallies in the dollar, but if you go back to 1972 and look, the dollar bought 360 yen, and now it buys 110. We've been in a major bear market. But, the problem for the dollar is the fundamentals have gotten so much worse in the last couple of years. The major Wall Street brokerage firms back in the 1990s, late 1990s, were very complacent. They advised people that, that the earnings didn't matter, the dividends didn't matter, that a lot of standard valuation matrices no longer mattered. And, of course, we had a collapse of that bubble. Today, Wall Street is making the same mistake with economics and trade, telling people that savings don't matter, that manufacturing doesn't matter, that current account deficits don't matter, that trade deficits don't matter. And I think the ramifications for investors and for the U.S. economy when the dollar collapses are going to be far more severe than when we had the collapse of the dot-coms.
Peter, what is the timeline that you're talking about, though, for this dollar collapse? I mean, a 10-year horizon, or is it something more?
Well, I don't think we've got 10 more years. I'd be shocked if we were to make it 10 more years. I think there's a pretty good chance that we're going to revisit the long-term support in the U.S. dollar index down around 80 between now and the end of the year. And I think if that test fails, and eventually it will, I think the dollar can be cut in half very quickly.
Peter, can I lay out an alternative scenario, and you can comment on it? I think the dollar is mostly responsible to what the to what the central bank does. So in the 1990s, Alan Greenspan said he was worried about irrational exuberance. He then set out to make the dollar more scarce, and the dollar indeed strengthened a lot in those subsequent years, 97, 98, 99. Real interest rates were high. Then after 9/11, the Fed cut interest rates a lot, and that weakened the dollar. And now we're in a period where there's more concern that the Fed may want the dollar to weaken or may be tolerant of dollar weakness. I'm sorry?
I'm listening.
And so I guess if we look from the 70s on, I think you can explain all the movements of the currencies by whether the central bank is trying to be tight or trying to be loose. Right now we're in a loose mode, so the dollar is weakening.
Well, there's no question. I mean, you commented yourself, there's liquidity. There's too much liquidity. That's one of the problems. And the other problem for the Fed is even if they wanted to defend the dollar by raising interest rates the way we did in 1980 when we had Paul Volcker, the U.S. economy is so vulnerable right now to interest rates with all the adjustable rate mortgages out there and the enormous national debt that's financed with Treasury bills that we can't even afford to try to stabilize the dollar.
Yeah, I think on the fundamentals that we're in a lot better shape than what you're laying out. One is on the national...
I'm sugarcoating it.
Okay, and the national debt relative to GDP is roughly 38%. That's small by international standards. The current account deficit is a lot of it driven by savers abroad who are really eager to get U.S. treasuries.
No, it's not. It's driven by spenders here at home. The problem is we're not producing as a nation. We're just consuming. And when you're comparing these numbers, these phony GDP numbers, our GDP numbers are a bunch of fluff. Look at the manufacturing goods that we import. Look at the percentage of what we consume. Tradable goods
we're going to have to
imported.
take this break, but please stay with us. We're going to be right back after this break.